One more time. Fast, fast. Good. Okay. Good evening, class. Welcome to our taxation class for today. Okay. We are going to be looking at an interesting topic, which is called taxation of companies' income and the Finance Act 2019. You know, we've been having people asking if the Finance Act 2019 will be tested in this exam. And we don't want to leave any stone unturned. We don't want to take any chances. And so we are using this opportunity to look at a full, complete company income tax question that will comprises of our basis period, capital allowances, and taxation. Then we will be applying the Finance Act 2019 as it relates to commencement and, if time permits, cessation of businesses. Now we have some ground rules that we need to establish here. First of all students should put their audio on mute. So we will not want you to unmute yourself, even if you have anything to say. Unmuting yourself is like making noise in the class. It has a way of distracting other listeners. It has a way of also distracting the lecturer. Also, I will advise that you don't on your video. On your video will also be a form of distraction to the lecturer. So everybody should be seeing just the lecturer and nobody else. Okay? Now, if you have any issue, simply, if you have any issue on connectivity, you call the helpline here, the number here shown on the screen, or you can go to the WhatsApp chat that you got your invitation link from and make your problem known. Okay? Now, if you have any question in connection with the class, I will want you to go to the chat room in Zoom here to type your question. Type your question in the chat room, and please use shorthand sparingly. We're all professional. Don't use shorthand too much. Otherwise, the meaning of your question may be lost. There's nothing like I want to do it fast. It's good to be very clear. Say what you mean and mean what you say. Okay? Also, if you notice that your question has not been answered clearly or so, you may want to use the WhatsApp forum to ask your question again. Okay? Now we'll be going straight to our topic for today, the taxation of companies' income and the Finance Act 2019. We'll be using one question to illustrate the whole fact. Okay? Now, before we start, let me refresh our minds on commencement rule and how it affects companies' income. In the old Finance Act, we have the commencement rule as follows. Whenever a business, just like as we have in exercise refresher 0.1, ZZ Nigeria Limited. ZZ Nigeria Limited was incorporated on September 7, 2012. Now, what does this incorporated date have on taxation? Just one thing. It only shows that by 18 months after the date of incorporation, your first tax return should have been due. But if you start business, you can also file your tax returns 6 months after the end of your company's year end, whichever comes earlier. If 18 months from the date of incorporation comes earlier, that is the date they will take. Now that's the significance of that incorporation date. It is used to know when your first filing is due. So some other people too, if you have not commenced operation, 6 months after your date of incorporation, you can file for tax clearance certificate. So these are just the two things for now of the incorporated dates. But as regards using it to help us to calculate tax or basis period, this is not useful. All right, so for now, that is not our intention. So incorporated date September 2012 is not our business for now. We are just assuming that they are going to file. It's of no importance to us right now. Okay? But the company did not commence business until July 1, 2013. Okay, so they registered their company as a limited company on September 7 to 12, but they waited till July 1. That is how many months? September, October, November, December. 4 plus 7. So they waited like 11 months before they now started their commenced their business. 11 months. Okay, so in 6 months time it is due for them to file their annual returns. So that's why in December of that year they are due to file their first return, which will make it 18 months after. Is it 18 months? Okay, it's not up to 18 months. So it's not up to 18 months. So September 2012 to September 2013 is one year. So they still have like 18 months to file their tax. So their due date for filing tax based on incorporation date 18 months will even enter 2014. But not to worry, we are not told when they file the tax. It's not important to us. So that's why we said the incorporated date is of no importance. But you see this date, July 1, 2013, that is very, very important. Why is it important? Because in commencement rule, 2 basis period is linked to that date. Now, what is the basis period for commencement rule? It's as follows. The first year of assessment is the year you started business. So year 1 is not 2012 when the business was incorporated. No, it is 2013 when the business commenced. So 2013 is the first year of assessment. What is the basis period for this first year of assessment? It is going to be based on actual year basis. Actual year basis. It means it's going to be from the date the business started to the end of the fiscal year. So July 1 to December 31st, 2013. That is the basis period for our year 1, 2013. Now, for the second year, which is going to be 2014, we are still going to be using this same date. And so we have basis period. Basis period for 2014 is going to be starting from July 1 again to June 30, 2004. So July 1 to 13 to June 30, 2014. 12 full months now from the date the business started. 12 full months. Now, can you see that from this old finance rule, there is an overlap between the first year and the second year? You know, the overlap is the months that are common in those two periods. So you can see the overlap period is July 1 to 3 to December 31st to 3. That is the period common to both of them. It means any income you make in that overlapped period will be charged to tax twice. So you see some of the reasons why they have to change the old Finance Act to the new one, because of overlap problems. Now, the third year of assessment, which is the third relevant year for commencement, is the third year in business, which is 2015. Now, 2015 will be on preceding year basis. So you know, 2013 was actual year basis. 2014 was partly actual, partly preceding, partly actual. This is because the beginning period was kind of preceding, but it ended in an actual year. So partly preceding, partly actual. But the third year of assessment is fully preceding. Fully preceding. It's going to end on the date the company gives as their company year end. So now, this July 1, 2013 is not significant for the third year. What is significant is they bring their accounts ending December every year. They bring it ending December every year. So that's the significance. December 31 is significant for the third year. So if the third year is 2015, that means your basis period must end in 2014. So your basis period must end in 2014 December. That means it must have started from January 1, 2014. Now that's fine. These are the three basis period in the old finance rule. We are going to be seeing how we are going to apply this rule in this question. Then when we are done, we'll look at the new finance rule and see what changed between the old Finance Act and the new Finance Act, and which one is better. All right. Okay, so let's look at this question. Now, we are reading from the second paragraph. Extracts of the company's statement of profit or loss and other comprehensive income are given as below. As given below. Now we have 6 months ended December 31st, 2013. So if I were you, I will ask myself, this 6 months ended December 31, 23, when did it start? So if you count 6 months back, it must have started July 1, 23, 2013, which is the date the business commenced. July 1 to 13 to December 31st to 13. The second one here is January 1 to December 31st to 14, like that, January 1 to December. Okay, now you are given the following items. You are given revenue, you are given direct cost, you are given gross profit, the normal P&L for that financial reporting standard gives. Okay, you have your distribution cost, admin cost, other expenses, the profit or loss. This is what is declared in your P&L. This is just like the summary. Okay, now then you are given additional information that clarifies. Now, additional information. Other income comprises. Now, I want to bring something to your knowledge. When you say the word comprises, it tells you that they want to break down everything to all their component parts. Okay, so let me give you an example of what I mean. Other income comprises, okay, let's get to the what do they call it? Let's get to the other income parts. You see here that other income here has been added here. So it has been added here for us, 45,000. We have 458,150 and 201. If you look at the totals here, it is the same thing here. So what it means that they have broken down this other income. This other income, what constitutes other income has been broken down. And so what do we need to do? Okay, they have told us what are the constituents of other income. We have sale of scraps. For the first year, there was none. The second year, there were 57,000. The third year. Now, what you do here is this. You need to look for which, when they give you other income comprises and they give you the whole breakdown, you have to look for the one that qualifies to be in the statement and the one that does not. You were told other income comprises. Now there's a difference between comprises and include. When you say comprises, you are getting the full details. And you are now going to choose which one of them is allowable and which one is not allowable. But when you see the word included, I think it tells you that all of them is either not allowable or allowable. Most times it tells you they are not allowable. Okay, now look at this question. Sale of scraps, are they allowable or disallowable? Interest received on treasury bills, are they allowable or disallowable? Domiciliary account, are they allowable or disallowable? Okay, all right. The next one we see here is administrative expenses include. Okay, this is what we are saying here. Administrative expenses here is 4,810,810,550. But you see, they've broken some things down here. Can we add up all these ones here to see whether it gives you the same amount? I have my calculator here, 160 plus 216 plus 110 plus 2,060,000 plus 600. It gives you 3,106,000, which is less than 4,810,550. 550, yeah. So it tells you something that when they tell you include, it means that all of them is either not allowable. But sometimes you need to check very, very well if they are not mistaken. Like in this question here, it would be wrong to say that all of these are not allowable, because we know staff salaries are allowable and office rent is allowable. So that means the question just added this staff salary and office rent just to distract you. But in the case of comprise, they gave you everything. You need to be very, very sure which one of them is allowable, which one is not allowable. Ordinarily, from my experience, when they give you include, all of them are supposed not to be allowable. All of them should be disallowed. But now they have used staff salary and office rent as a form of distraction. Of course, you need to now use your common sense to say, okay, you're looking. So what you do is that whether you see comprise or you see include, be checking them line by line and be reasoning with yourself. Are these allowable? Are these disallowable? So anyone that is allowable, you tick it good. Anyone that is disallowable, you tick it bad. Now, if it is an allowable income, if it is an income that is taxable, I'll call the word taxable income, you tick it good. If it is non-taxable income, you tick it bad. For expenses, if it is allowable expenses, you tick it good. If it is non-allowable expense, you tick it bad. So what do we do to allowable income? Allowable income, since they have been recorded in the account statements, you allow them, you let them go. That's why you tick them good. But if you see an income that is not allowable, is tax exempt, not taxable, not taxable, you tick them bad. If they have added them before, all you need to do is to remove them. Then you do the inverse on expenses. All those allowable expenses you've ticked good, it means they will remain. But the disallowable expense that has been removed before, what do? You add them back. Okay, so that's what we look at here. Then we look at details of plant, property, plant, and equipment. Look at how they were stated here. Now, they gave us the items, furnitures and fittings, motor vehicle, office equipment. We'll need three information here. One, we need the date of purchase. It was given to us. And can you see these three of them? Two were bought in June. One of them was even bought on the June 30th, one day before the business started. So the two of them that were bought in June were bought before the business commenced. So what do? We assume that even though they were bought before the business commenced, we deem them to be bought on the first day of the business. And the first day of the business is July 1, 2013. So this one bought on June 7 and this one bought on June 30 are deemed to be bought on July 1 for tax purposes. And of course, office equipment was bought on the first day of business, July 1, 2013. So these three are deemed to be bought on the same day. Now, on January 2, 2015, the company bought another motor vehicle. So what happened? These ones that are bought on the day the business commenced, you have to prorate their annual allowance according to the number of months in the basis period. But the initial allowance, you don't prorate. You give them full for the year. Now look at this motor vehicle that was bought on January 2nd, 2015. Now, since the basis period is January to December, so this probably is going to be giving full capital allowance on annual allowance on the year it was bought because it was used throughout the basis period. So you need, when you are looking at asset that you have bought, while you are charging the capital allowance, initial allowance fully, the annual allowance, you need to check how many days in the basis period that the asset was put into use. How many months in the basis period, rather, that the asset was put into use. Okay, we are also giving extracts of the financial position. Okay, now look at the financial position. The only reason they will be giving you financial position is for one thing. And once you see these two things, it tells you something. You see net assets, and most especially you see paid up capital. This paid up capital is the key word I want to talk about. Once you see paid up share capital, it only tells you you want to do minimum tax. You want to do minimum tax. So minimum tax has 4 elements. Paid up capital is there, net asset is there. So that's the two things that could make up your extract of your financial statement that they are bringing to you. It does also, minimum tax has 2 other elements. Gross profit, which was given to you here in your financial statement. Gross profit is there, and we have revenue already given to us. So we have all the ingredients needed to do minimum tax. So once you see net asset and paid up share capital, get ready for minimum tax. Now this question is a 30 marks question, and it's loaded to the teeth. Now, you are recently appointed the tax consultant to the company. The director sought your advice on whether or not to exercise the company's right of election for the relevant years of assessment. What is right of election? Right of election simply means your right to ask the tax authority to assess your record, not on normal basis, but on actual year basis. If that assessment will favor you. How will it favor you? By giving you small amounts of tax. You know, because a business is just starting, the tax authority says that the taxpayer has a right to opt for a lower tax during that first years that the business is just growing. And so the business owner is given the right of election. He can take the right, he can forfeit the right. If he takes the right, only when it is favorable to him, the tax office will respect it. He can say, let me let go of my right because it does not favor him. We'll look at it in the old finance rule, and we will see how this right of election fare under the new finance rule. Now, for all relevant years of assessment, so they say for all relevant years of assessment, you have to identify the relevant years of assessment. You are required to, 1, compute the adjusted profit or loss. Now, you need to identify the relevant years of assessment. That gives you mark. How will you know the relevant years of assessment? For one thing, You have noted here that the company is doing commencement rule because they said they commenced business on so and so day, July 1, 2013. So you have seen the keyword for commencement. The commencement rule will be used. Once you get the commencement rule that you establish that that is what we'll be using, look for the first year of assessment. And I told you the first year of assessment, the first relevant year is the year the business commenced. The business commenced on July 1, 2013. So the first year is 2013. That will make the second year to be 2014, the third year to be 2015. Okay, so let's see how we can do this A part of the equation. Adjusted profit. What is this adjusted profit? What is this adjusted profit? Okay. This adjusted profit is going to be like this. You have been given net profit that has certain things that were not supposed to be inside the net profit. And so what do you do about them? You either remove them or you add them. Okay? So now let's go back to our net profit figure. Let's go back to our net profit figure and let's analyze all these items here. And the items that we need to analyze are those things that are spotlighted for us. Okay? Now, if you look at this profit statement, it is not bad in itself. Of course, gross profit is allowed, other income, distribution expenses, admin expenses. Look at the profits that we are highlighting. We are asking ourselves, is this profit right for tax? Do we need to adjust it? Oh, yes. So first of all, bring this profit as per account. This is what we started with, net profit per account. That is what we started. If you see the heading, computation of adjusted profit or loss, as it was given to you in the question. Now, this is the net profit that you got. In the year 2013, you had a net loss. Okay. Now, the next thing to do is look at all your expenses. Which one of them are not allowed? Let's look at expenses. Additional information 1 talks about income. Additional information 2 talks about expenses. Okay? Depreciation is not allowed. So depreciation is not allowed. So you must have included them in admin expenses. And you know our admin expenses were deducted. That means you must have deducted depreciation when you were deducting admin expenses. But you're not supposed to include depreciation. Now that you've deducted depreciation, normally in accounting, you're supposed to raise a journal to correct it. So now you are correcting it. Now you are going to add back that depreciation that you deducted because you deducted it as allowable expense, but they are not allowable. So depreciation is not allowable. You add it back to your net profit so that your net profit will increase. The next one is preliminary and formation expenses. Preliminary expenses are those expenses you made before the business commenced. The law says that when you make all these expenses before the business commences, those expenses, especially formation expenses, expenses that has to do with forming the company, and some operational expenses, they are not expensed. They are capitalized. So you don't take them off in the first year. You spread them over the life of the business. So, for example, let's say before the business commenced, you went to register your company, the money you pay to lawyer, the money you pay to CAC, the money you pay to get your certificate, to do everything before the business commenced. That is what amounts to 216,000. You're not you're not supposed to expense them for the first year. You are supposed to capitalize them over the life of the business. So you must have deducted them. You have to add them back so that your profits will not be understated. Then the next one is penalties and fines. Penalties and fine. Assuming you paid your tax or assuming you kept to the law, you won't be paying this fine of 65,000. But because you are not in the right side of the law, you pay these expenses. Then it is not right for you to deduct it from your profits. That is why it is called a fine. Let your profit be as though you've not paid the fine, so that you'll be taxed appropriately, even though you paid a fine. So paying the fine is a punishment for breaking the law. Maybe you filed your returns late, or you beat traffic and others, and you now pay that because that is a punishment for breaking the law. So for deducting it, it is not right. Then we have general provision for bad debts. Yes, bad debt is allowed. Bad debt is allowed. But provision for bad debts is a different thing. Now, bad debts, why is it allowed? Because it has already occurred. Somebody has declared bankrupt, is owing you 2 million. That 2 million is a bad debt. So you write it off. But when you are doing provision for bad debts, you are making provision that, okay, what if this my customer goes bankrupt? Or what if so and so person dies? Excuse me. Now you are making provision. The law says if your provision for bad debt is specific in nature, it is allowed. But if it is general in nature, it is not allowed. So general provision for bad debts is not allowed. Hence, since you've deducted it before, you have to add it back. Now look at staff salaries. Staff salaries are allowed. There is no note that contravenes the there is no note here that states that anything that will make the staff salary to be not allowed. If you were told that staff salary include money paid to the son or daughter of the MD, who is not a staff, then that part should be disallowed. But here they are just saying staff salary is allowed. Office rent is allowed. There is no clause that said here that maybe the man is working from home and is converting his house rent to office rent. Of course, if he's working from home, is only a part that he kept as his office at home that should be treated as office rent, and not everything. But there is nowhere in this question that tells us that gives us information to disallow office rent. So staff salary and office rent, these two are allowable. And you've deducted them already when you are deducting administrative expenses. So do nothing about them. It was right, you deducted them. Do nothing about them. They are all allowable. That's why you marked them good. But those ones here I've talked about, you mark them bad, you have to add them back to your account. And that's exactly what we did. We add depreciation, preliminary and formation expenses, penalty, and provision for bad debt, general provisions. Okay? Then, what about um, um, income? Look at this income. They said comprises. That means some of them are allowed, some of them are not allowed. Let's analyze them. This company is dealing with, what do they call it? It's dealing, okay, distributorship and general contracting. So now, this is sale of scraps. This is their operational goods that they are selling, but some of them have become scrap. And so they are selling them at a very small price. Is that income going to be taxed? Of course, it's going to be taxed. So this one is taxable. And so if you ticked it good, do nothing about it. Because it's scrap, your stock in trade became scrap. It's still your stock in trade. Let's say you are selling bread and your bread you're supposed to be maybe supposed to be fresh, and maybe because of something it has gone scrap. Though you cannot sell it the way you sell your normal fresh bread, but you are still going to sell it as a scrap. You're still going to be taxed from it even though it's scrap. So it's good, do nothing. Now, this is interest received on treasury bills. Treasury bills are government bills. These interests are tax exempt. These interests are tax exempt. And so, if these interests are tax exempt, you should not show it. It should not be part of your income. It should not be part of your income. But you see, other income has included it. That means it has added to your other income. It's as good as saying they want to find tax on something that is tax exempt. It has increased your income. So what do? You need to remove it from your income, from your taxable income. So it means that this 325 and 120 has to be deducted from your net profit so that your profit will reduce because these are tax exempt items. The same thing applies to interest on domiciliary accounts. Interest you receive on your domiciliary account, the law says it is tax-free, tax exempt. Now it has been included. By including it here, it means it has increased your income and you're going to be taxing them. So let's remove them so that we do not tax them. So you see here, we have removed the treasury bills, we have removed the domiciliary account interest. So can you see the systematic way we walked through? For expense, when you are dealing with the net profit, you add back all the expenses that are not allowed. We call them disallowed expense. You have already deducted them. So you add them back to show that it was an error, you deducted them. Add them back, that increase your profits. Then you go to income. Those income that are supposed to be exempt, tax exempt, you're not supposed to have added them, but you have added them to your income. You do the opposite. You reverse it by deducting. When you do that, you find out that your adjusted profit becomes 211,550 for the first year, which is 6 months ending December 31, 2013. Then for the 1 year ending December 31, 2014, you have 4,368,320. And for the last year, which is the one ending in December 31, 2015, you have 7,788,800. Now that's your adjusted profit. That's your adjusted profit. So you've adjusted it from what it was the net profit. The net profit is the accountant's profit, to adjusted profit, which is like what the taxman uses. So this adjusted profit could otherwise be called accessible profit. But to call it accessible profit, it needs to undergo another type of adjustment. That the adjustment is not because of these items that are allowed or disallowed. No, the adjustment that will make adjusted profit to become an accessible profit is because of basis period. Now let's look at the question part B. We've done part A, which is adjusted profit. The next one is determine the accessible profit or loss. That's one part. And you see this word and, it means there are two sides to this question. The first side to the question is the one before the and. The second side to the question is the part after the and. So what is the second part of the question? Advise the company on whether or not to exercise its right of election. Now, anytime you are doing commencement rule, always note it at the back of your mind that you will always do right of election. Now, that is based on the old rules. Except the question tells you to ignore right of election, then you ignore. When the question did not tell you to ignore, always do the right of election and advise whether it should be exercised or not. So can you see it's going to give you 6 marks? The first one we did was going to give you 9 marks. And it's so easy to get that 9 marks. And it's also so easy to get the 6 marks. But you see this 4.5 marks, that is where the work is. That is where the bulk of the work is, but you are getting 4.5 marks. But without that work, you cannot get the other 10.5 marks. So you see, all of them are moving in a step. Now we've done the first one, let's do the second one. Determine the accessible profit. For us to determine accessible profit, we need to know basis period for profit, and then the profit will be adjusted. Okay, so let's go to the B part. This is the basis period for profit. Now we have normal basis period and we have actual basis period, which is the election basis period, optional. Now the normal basis period is what I stated at the outset. Year 1, which is 2013, it has to be from the date the business commenced, July 1 to 13, to end of the fiscal year, December 31st, 2013. And from our question here, if you look at what we've done before, look at the A part, this was your adjusted profit for that period. And it is still 6 months to December 31st. And the 6 months period that is covered here, and that is what we have here as our accessible profit. So our adjusted profit became our accessible profit. No problem, no adjustment required. Let's look at year 2014. Year 2014 is going to be 12 full months, which will start from the date the business commenced, and we end 12 months later, 30th June 2014. Now, we are going to be breaking it down into 2 because we don't have figures from here this figure that we are giving here is longer than what we need, even though this is a 12 months period. Now, if you notice, this 12 months period can be broken down into two. The first one is from the date the business started, which corresponds to this one here in year one, down to the where year one ends, which is the overlapping period. So it can be broken down into overlapping period and the one that extends out of the overlap. So this is the overlapping period from July 1, 2013 to December 31st, 2013. So this is the same figure we have here that we have here. It's a loss. Then the second part that starts from the next day where this one ends, January 1, 2024 to June 2004. What do we have? We have 4,368,320. So all we need to do is, since this figure is a January 1 to December figure, and we are only looking for January 1 to June 30th, we have to prorate 4,368,000. So you calculate 4,368,000. What's the other figure? 368,320. 320. So that's 12 months figure. So you divided by 12 to know how much for 1 month, then multiplied by 6. In other words, they say by 6/12, anyone, to give you 2,184,160. 2,184,160. That's what we have here. So you see, this profit makes up for the loss. So we find the net. When we find the net, of course, it becomes 1,972,610. That is what your second year profit, accessible profit, is. What about the third year? The third year is the preceding year. So we say the third year is preceding year. Now, how do we know something is preceding year? This is 2015. The end date must be 2/14. That shows it's preceding year. There will be no two ending. There will be no two accounts ending on the same year. No two accounts should end on 2014. Now you see, this is 12 full months. So if it is December 31st, it must have started from January 1, 2014 to December 31st, 2014. And you see, this is the only figure that ends with December 31st, 2014. This same figure we used last time, this is the same figure, 4,368,320. So you see, that's why we're using it here. Now, what do we do after we've done the first 3 years? We'll simply add year 2 and year 3 together. We simply add year 2 and year 3 together. And when we do that, we get 6,340,930. Why are we adding year 2 and year 3 together? Because that is our basis for comparison to advise whether we will do a right of election. Now, we are supposed to have stopped after year 2 and year 3, but our account still lends us to find year 4, which is 2016, because we are giving information for 2016. So 2016 year of assessment, basis period will be January 1, 2015 to December 31st, 2015. And we are giving 2015 December account, 788,800. And now that is that figure here. Okay, now that we've done the normal basis period, let us check our right of election. Our right of election just concern only year 2 and year 3 because year 1 is the same thing. So if you look at year 1 in the right of election here, year 1 is on actual year basis. The same thing here, it doesn't change. Year 2 is what is different, and year 3 is what is different. Now, we are saying that year 1 was actual year basis. Why not make year 2 actual year basis and year 3 actual year basis? How do you know something is actual year basis? One, you look at 2014 here, you go to the last date, it is 2/14. And you see it is December 31st, 2/14. You know it's actual year basis. You go to the beginning, you see January 1, 2/14, that same year, you know it's actual year. In fact, what you know is actual year is when you look at the start date, it's 2/14 with the assessment year, and you look at the end date, it's also 2/14. So it starts from 2/14, ends from 2/14. It doesn't matter whether it is January 1 or December. As long as the year of assessment is 2/14, basis period, the beginning is 2/14, ending is 2/14, that's a pure case of actual year basis. The same thing with 2/15, you see this actual year basis, 2/15, 2/15. Now, what are their figures? Thankfully, we don't need to adjust because our figures were giving us to 31st December of these 2 years. So if you look at it, this to 31st December, this figure we are going to take here for actual year basis. This your adjusted profit becomes your assessable profit. So that is what we will look. Then when we add the two of them together, the second and the third year, we have something higher. If you look at the fourth year, you don't do anything on the fourth year because the right of election has no effect on the fourth year. Because you see, 2016 is on preceding year basis, has nothing to do with actual year. It's on preceding year basis, just like this one. So when you are looking at commencement rule, right of election, just go straight to year 2 and year 3 and look for their assessable profit, then find the total. When you find the total, compare it with the total you got from the normal basis. That is your basis for advice. Now look at your advice. It is better for the company not to exercise its right of election. Why? Because tax will be saved if they do so. Now, tax will be saved on accessible profits. So you look at this accessible profits here. If you have told them to exercise your right, it means that they'll be charging you tax based on 12 million. And if you say, no, I don't want to exercise my right, they will be charging you tax based on 6 million. Which one will provide a lesser tax is when you don't exercise your right. Which one will produce a higher tax when you exercise your right? So you are saving yourself tax, and you are saving yourself tax when you do not exercise your right. You know, sometimes some people want to window dress their profit. Somebody who wants to window dress his profit will want to choose this. But if you have tax in your mind, you will not want to choose that. You want to choose the normal basis period. Now we've answered question B. Let's get to question C and see what is obtainable in question C. Question C is talking about the capital allowance. Question C talks about compute the capital allowance for 4.5 marks. How do you compute the capital allowance? You will need this capital allowances table. So this is the table for capital allowances. you need these tables for initial allowance and annual allowance. So let's see how we can apply them. We'll go back to our capital allowance. This is our computation. These are the items we bought from our question here. They gave us 3 items here we bought, and then I said we bought another motor vehicle. So it only comprises of these 3 items: furniture, motor, and equipment. These are the 3 things here. Now, these are the initial and annual allowance we cut from here. For furniture, we've seen that office equipment. Okay, furniture is 2520. 2520. Okay, office equipment is 5025. Office equipment 5025. Then look at motor vehicle. Motor vehicle is 5025. 5025. So we've done that. So we don't need to come back here and be looking at capital allowances. You put them up at the heading. Okay. Now, what do we need to do? Now, we said these 3 items were deemed to be bought on the first day of business, July 1, 2020. 2013. So your assessable year, the first year is 2013, and you know it's 6 months. All the assets were used for 6 months in the basis period. So what we did now, we got the cost of the assets, which is these figures. And when you add them totally here, this is the total cost of the assets. Now, you need to look for the initial allowance. So all we need to do here is to look for initial allowance figure is 25%. You look for 25% of 980 will give you 245,000. Excuse me? In the second motor vehicle, 50% of 2,400,000 will give you 1,200,000. And 50% of office equipment, which is 1,200,000, will give you 600. When you add the total, sorry, the total jumps here. Sometimes when you are converting from PDF to from Word to PDF, you see things like this. So just use your biro to repeat this figure here, because this is where it's supposed to be. Okay, then we have your annual allowance. How did we calculate this annual allowance? I will use one as an example to see what we did. Let's look at this 73,500. How did we do it? We start with the initial allowance, with the cost, 980. So let's start. Cost, 980,000. Okay. We look at initial allowance, 245,000. You less it, minus 245,000. You have 35,000. That is your depreciable amount. So what do? This 20%. This 20% is your annual allowance. What we are simply saying is 20% on this remaining value. If you look for 20% of this remaining value, which is times 0.2, is 147,000. That is what it means. 20% of the remaining value. That is one way to look at it. Another way to look at it is this. If you take 20% of 735,000 every year, which is happening to be 147,000. If you take 147,000 every year, how many years is it going to take you to clear up all these 735,000? It's going to take you 5 years. How do we know? 20% 20%, 20% into 5 places will give you 100%. So it means it is 5 years. So another way of achieving this 147,000, instead of multiplying by 0.2, let me bring it back. Instead of multiplying this 735,000 by 0. Instead of multiplying it, you divide by 5 years. If you divide by 5 years, you are still getting the same 147,000. So either you say 0.2 multiplies. So don't go and get it twisted and go and say 735,000 divided by 0.2. No. So that you say 735,000 multiplied by 0.2 every year. Or you simply say 735,000 divided by 5. Both will give you 147,000. Now this 147,000 is your annual allowance for 1 full year. But for the first year you put it, you didn't spend 1 full year. You need to prorate it to the number of months you use the assets. We use the asset between July to December. That's 6 months. So we need to say multiplied by 6 over 12. So you have 37,500 for the first year. 37,500. That is how we got this 37,500. If you do similar to others, you will get these figures. Just the way we got 37,500, you do the same thing, you get the others. So when you add this 37,500 to 150 from motor vehicle and 75,000 from plant and equipment, you have a total annual allowance of 298,500. So what do you need to do? You have your costs, you less your initial allowance, you less your annual allowance. The result is your tax written down value. Written down value which will be carried to the next year, 2014. So you see, this happens to now be your tax written down value of total assets, tax written value. But it's not important to us. What is important to us is the total tax, the total capital allowance. How do you get your total capital allowance? You add these two things in brackets, 2,045,000 plus 298,500. That gives you your capital allowance. One is for initial, the other one is for annual. Okay. All right. We go to the next year. So look at what we do next year. This is your tax written down value for this asset you brought the next year. What is going to be your initial allowance? What is going to be your annual allowance? Now there are two ways we calculate annual allowance after we've done the initial allowance. I'm still going to teach you the two ways. One of these way is what I've just done here. The second way is what I will do when we are doing the Finance Act. So both ways is correct. You just have to be consistent in which one you use. All you need to do is, after getting your 661,500, 666,500, that's your annual allowance. So all you need to do is to divide it again by the remaining number of life. So 20% we used before was for 5 years. Now 1 year is gone, you are now left with 4 years. So you divide it by 4 years, When you divide it by the remaining 4 years, you are having 165,375. So that's how you get this figure. Now, this one you have here, for you to get this figure, you divide the remaining, since it is 4 years, 1 year have passed, you divide by 3 years. When you divide by 3 years, you get this remaining figure. Same thing here, you divide by 3 years because 1 year is gone. So when you add all of these, annual allowance, you have 690,375. That's fine. That's the one method to use it. And once you've started that method, you have to be consistent. Now, when you less your tax written down value from when you less your annual allowance from your tax written down value from the beginning of the year, you get the tax written down value that will be carried to next year. Okay, all these are carried to next year. Now let's look at it again. In the year 2014, you still have another annual allowance to be deducted, to be brought. Now you have 496,125. That is your depreciable amount. 2 years have passed before you derive this figure because this is the beginning of the 3rd year. 2 years have passed, this is the beginning of the 3rd year. Now, how many years is remaining when you got this figure? It's remaining 2 years. So you divide it by 2. Sorry, you divide it by 3 because this is 5 years. You spent 2 years. It's remaining 3 years. So we have 496,125. You divide by 3. You are still getting your 165,375, which is the same thing here. So it's as good as saying consistently put it. Now, in the case of this other one that is 700,000, which is for 4 years, 2 years have passed. So the remaining 2 years you divide by 2, you still get 350, which is the same thing you're using. The same thing applicable here. So all you need to do once you found the 2nd year annual allowance, keep repeating it. So you repeat the 2nd year annual allowance here in the 3rd year. You find the tax written down value. You now go to the 4th year. Now, if you notice on the 4th year, we were told that in 2015, January 2015. So because it is preceding year basis, 2015 basis period will fall in 2016 year of assessment. We bought another motor vehicle for 1,800,000. So we are adding this 1,800,000 to this 350. It means total assets as at January 2 happens to be 2,150,000 for motor vehicle, including the addition. So whenever you have a purchase of new vehicle, you look for the initial allowance of that new asset. 50% on this is 900. These other ones, you don't have any asset purchase, so they remain 0. Okay, then annual allowance. You can start with the old asset, you can start with the new asset. So the new asset which you just bought, this is the annual allowance. How did you get it? The cost is 1,800,000 for the new asset, less 900,000, which is the initial allowance. You will be left with 900,000. Now the remaining 900,000, you have to look for the annual allowance on them, and it's supposed to be spread for 4 years. So you divide 900,000 by 4, which is 225. Now, when you have gotten 1 year annual allowance, check when the asset was bought and how many months in the basis period was it used. The asset was bought in January and it was used from January to December. So full 12 months were used on the asset. So that's why you apply the full 12 months for it. Now that is for asset with addition. Now the last one is the old assets. So you keep repeating what you did before. So this is the 4th year. This is the 4th year. This is supposed to be a 5-year period for furniture and fittings, but this is the 4th year. So you take the same amount as you've been taking previously. Now, coming to motor vehicle old assets, you cannot take what you've been taking before. So all you now do is you take 10 naira less than what you took before. You take 10 naira less. Okay. This is supposed to be 344, not 334. It's supposed to be 344. But let's just hope that let's assume it was correct. So I think it was 344 that should have been here, but the calculation here is the second one is right, 690 and 10, and here 690 and 10. Why is it 690 and 10? It's because the 600, 690 is what you get when you deduct initial cost from initial allowance from annual allowance on the old assets. You get 690,000. Okay, 690,000. Then the remaining 10 naira comes from when you deduct. Okay, sorry, you get 600,000. The other one goes from when you deduct the annual allowance that is supposed to be done for that year. Okay, 649,990. Yes, 634,990. That's what I said is the old asset figure. So this 690,000, the only 10 naira here is coming from the old assets, which annual allowance figure has been fully claimed. But the 690 is the tax written down value for the new assets which will be carried to next year. So just hold on a moment. Yeah. So you carry it to the next year, no problem. Okay. Then somebody is saying recap the old and the new annual allowance. You do them one by one. You just do them one by one. All you need to do is whenever you have a new asset, take it and treat it alone. This is the new asset here, 180, 1,800,000. Simply look for the initial allowance on this 180. It will give you 900. You will say initial allowance minus cost minus initial allowance. Whatever it gives you, look for the annual allowance on it alone. It's going to give you 225,000. This is the same way we have been doing initial allowance when we started in the beginning. So we said we are supposed to prorate this figure because it was the first year we are using the assets. But we used it for the whole basis period, 12 months. And so we give it 12 months proration, full. Can you see that here and here we are 0, the other assets were 0, 0 because no new addition. Then we come back to the old asset that we've been carrying since 2013. Look for their annual allowance. We'll be using this annual allowance continuously. So we carry it. And we've been carrying 350 before. We'll look for 10 naira less of it. Here it's supposed to be 340, 349. Here it's supposed to be 349,990. Not 334. So yes, a little mistake, but it doesn't affect. It may just affect our answer a little, but not to worry. The only thing you do here is you only get one figure wrong, just this. But every other one, since they know where you got your answer from, they will give you your answer correct. It's just only here, this side, that you got the figure wrong, that you are getting the wrong answer. We're all imperfect. Maybe I may have been rushing and I used the wrong figure, but don't worry. So that means that this figure may be wrong, but not to worry. This tax written down value has no mark. It's only the capital allowance figures that have marks. The capital allowance figures that have marks. So all you now do, you remove 10 naira from this, which is the same thing here. Yes, this one was correct. So 10 naira will be left. So you add your allowance, annual allowance, you add this, and you add this. They all give you this. So what do? Your allowance, capital allowance figure for 2016 is this 900, which is initial allowance, plus 225,000 plus 509,980. These three will make up your capital allowance for 2016. Okay, so we've done the C part. Let's get to the D part. The D part says compute tax liabilities, 10.5 marks. How do we compute tax liabilities? All we need to do is 2013, we had a loss. We had a loss. You remember how we calculated our assessable profits? If you look at it now, we didn't exercise our right of election. So we're using this assessable profit here. So we had a loss of 211,550. Then our capital allowance. How did we get our capital allowance? I said it was the addition of these 2,045,000 in total terms plus this 298,500 under total. Add them together, it gives you this total capital allowance. And that's fine. There is no way you can claim capital allowance from a loss. So you carry your loss to the next year, carry your capital allowance to the next year. So your total profit is nil. Total profit is nil. Your company income tax is 30%. That's fine. Your education tax is also nil because there was no assessable profit. You go to the next year. In the next year, your assessable profit, you know where we got it? Is this figure here. So that's what we are using here. Assessable profit. Then you are bringing this loss you carried from last year. You bring it forward and it gives you this. Okay? So this is your loss brought forward. Now your capital allowance. This was brought forward from last year. And this is what you acquired for this year. How do you get the one for this year? You see it here, we only have annual allowance. So you just take it. So that's it here. But if you look at it, you add the two of them, it is becoming 3 million something. But you have 176,160. Now this company is not a manufacturing company, it's not an agricultural company, and so because of that, the capital allowance is restricted to 2/3 of the assessable profit. So you do 2/3 of this figure, 2/3 of this figure, and you have this. So this is the highest you can relieve. So out of the 3 million plus, you can only relieve this. So you are deducting this one, you are going to relieve. That means this is what you are going to carry to next year. Now here you are actually relieving them. When you minus it from this tax, this accessible profit, you have the total profit of 587,020. Of course, you can look for your income tax and your education tax. You go to the next year, which is 215. You brought this from your accessible profit figure where you got it. This was the capital allowance from last year, if you can remember. It's from last year, unutilized. Bringing it here. This is your capital allowance for this year. If you can realize, it's from your graph, from your, yeah. So you are bringing them. You add them together, you have this. So, but when you now look for 2/3 of your accessible profit, it's going to be higher than what you have available. So, since it's going to be higher, you just bring this lower figure. So, when you minus it from the capital allowance for the year, it means that you don't have any to carry forward. That means your total profits will be left with 1,836,110. It's from there you look for your profits and you look for your education tax from accessible profit. Then you go to the last year. The last year, you are going to be seeing this 7 million accessible profit. That's fine. Capital allowance, you know where we brought them. I told you it's an addition of 3 things here. It's an addition of this initial allowance, annual allowance for new assets, plus the annual allowance for the old assets. Some of them are just leaving 10 naira with it left. So when you add them together, you have that figure here for capital allowance. So now when you look for 2/3 of 7-point-something million, it's going to be higher than this figure. So that's why we are leaving it directly. And this is going to be our profit. No capital allowance to carry forward. Our profit is this, 6,153,820. Look for your income tax. Look for your education tax. I told you before that the question has ingredients for minimum tax. But the law says that a company that is within its first 4 years of business, which is 48 months, is exempted from minimum tax. That means whenever you are doing commencement rule, never ever do minimum tax. You are exempted from minimum tax while doing commencement rule. In fact, for the first 4 years, if you have a loss, you don't pay any tax. Minimum tax does not apply. Minimum tax applies from when you are in the 5th year. So even if you make a loss, they will calculate your minimum tax and the minimum tax will be used. I know what is the minimum tax computation. I have a formula for that. I call it GAP-T. It is 0.25%, 0.5% of gross profit, 0.5% of net assets, 0.25% of paid up capital, 0.25% of turnover. Whether the company is having 500,000 naira as its turnover or not, you do the same thing. Then for any company who has a turnover of more than 500,000, after doing these first 4 things, you will now look at the difference or excess it has over 500,000 and charge that excess alone on 0.2125% of that turnover. Yeah, of the excess turnover. That's your minimum tax. So in the first four, what you'll be looking at is which of them is higher. Is it when you do 0.5% of gross profit, or maybe 0.5% of net assets, or 0.25% of paid up capital, or 0.25% of turnover? Which one of them is higher is what you pick. Then you will now check if the company is higher than, has a revenue higher than 500,000, you do the second part. You do the second part. Somebody is asking, says, please, when are we required to prepare the solution C? Which one is solution C? Solution C, we are told to prepare capital allowance. And that is what we just did. So I don't understand. The question asks us to prepare capital allowance, and we are preparing, we just finished preparing capital allowance, and we just finished preparing tax. So this is the C, compute capital allowances, and we did it. And we went to D, compute tax liabilities, and we did it. Okay, let's go to the other part, which is the finance bill part, the new finance act, so that we will get the best benefit out of it. Let's look at how the finance, somebody say tax liability. Tax liability is not in C, it's in D. When are we required to prepare the solution D then? We are asked to compute tax liability. So just follow the question and compute tax liability. There's no way you can compute tax liability without knowing assessable profit and without knowing capital allowance. So the question was logical. Look for your capital allowance, look for your assessable profit. That's why we did it in B. We cannot do assessable profit without adjusted profit. That's why we did it in A. The question is logical. Get adjusted profit, get accessible profit, decide whether you are going to elect or not, then go and compute your capital allowance. Accessible profit and capital allowance, of course, accessible profit less your capital allowance will give you taxable profit. It is your taxable profit that you are taxing. 30% of taxable profit, that is going to be the company income tax. Then you also do education tax. Let's get to the Finance Act. Let's use the next 15 minutes to do that. Now, look at the same question I'm going to give here, but the thing is, the only difference is that we are going to use the New Finance Act as our basis for taxation. Now, if you look at the adjusted profit, the Finance Act has no hold on the adjusted profit. So whatever you did when you are doing computation of adjusted profit in the old rule still applies in the New Finance Act. It didn't amend anything on how you compute your adjusted profit. That is not the aim. So part A here is the same thing. Now let's go to part B where we'll get interesting things. We are asked to look for the accessible profit. And that's where it becomes interesting. Now the basis period under commencement rule has changed with the New Finance Act. Now the basis period for the old Finance Act, the old one, we normally look at year one, the date the business starts to end of the fiscal year. In year two, we still go back to the date the business started and did 12 full months. All that has changed. In New Finance Act, there is nothing like actual year basis. Nothing like actual year basis. Everything will be on preceding year basis. That's the rule, preceding year basis. That means if your business starts on July 1, 2013, you can never charge tax on 2013 year of assessment. Never. So your first year of assessment will be on preceding year basis. So your first year of assessment must be from 2014. In fact, look at it here. It says, for the first year, the assessable profit shall be the profit from the date in which it commenced to carry on such trade or business in Nigeria to the end of its accounting period. Now look at it. The end of the accounting period is now the most important thing in the New Finance Act. In this our question, the accounting date is 31st December every year. And that will mean that our basis period will be from January 1 to the end of the accounting year. We no longer say end of the fiscal year. Whatever we choose as our accounting year, from the date the business starts to the end of that accounting year, that is your first year. Now, if you watch, this date is in 2013. That means our first year of assessment. So that's difference number one. Everything must be on preceding year basis. So there is nothing like first year of business 2013. No, it's going to be 2014. Yes. So somebody says the question going to state whether we are going to be using the New Finance Act or otherwise. If the question says nothing, then don't use the New Finance Bill. If the question says use the New Finance Bill, then you use it. The reason why I'm teaching this is because if the question says use it, that's when you use it. And how will you know if the question will ask you to use it? Normally, since it is Finance Act 2019, any question that tells you the company started in 2019 will be using New Finance Bill. Any question that tells you the company started operation, started business in 2019 or 2020 will be using the New Finance Bill. We are adopting it here in this question so that we just see the difference. So, but if the question is telling you 2018, you will not use the New Finance Bill. If the question is telling you 2018, the only thing you can do is you use the old Finance Bill for year 1, you use the old Finance Bill for year 2. But when it comes to year 3, you must use the New Finance Bill. So the old Finance Bill for year 1, if it is 2018, you start to be 2018. Second year will be 2019. But the third year will never be 2020. It will be 2021. So you will be losing 1 year, which is loss on year of assessment, not loss of basis period. Okay, we are still using this our old question to understand how the New Finance Bill work. So in our old Finance Bill, our year 1 was 2013, here it is 2014. Basis period ends at preceding year basis. This thing is not from the date, this is from the date the business starts. Now, it is not the actual year basis. If you can see it, it is ending on the choosing accounting year end. Now, let's say the account is supposed to end in June. Let's say the account is supposed to end in June. They started in July 1 and they are bringing the account to June 30th every year. Now, look, all you need to do is from this date the business starts, start counting until the end of the accounting year. So it's going to be July 1, 2013 to June 30th, 2014. Now, because we are saying preceding year basis, 2014 will never be your year one. Your year one will be 2015. So can you see now? You started business in 2013, but we said the law for first year is choose your account ending date. Now, when you choose your account ending date, it's going to be on preceding year basis. So it means that your first year might be smaller than 1 year or might be exactly equal to 1 year. So from this, it depends on when you started your business and when you choose as your accounting year end. So that year in which you started your business, you will never be taxed. So you may be taxed on the second year, depending on when your first year ends. So if your first year ends on the same year with the year you started business, you will be taxed the next year. But if it jumps to the next year to end, you will never be taxed on that year that your account is ending. Preceding year basis shows that you are, if it starts from July 1 and maybe ends in June 30th, 2014, 2014 can never be your first year. It's going to be 2015. That's the new law. Always preceding year basis. I'll tell you the reason why. Now look at the second year. For the second year will start the next day after the first year has ended. And the second year will always be 12 full months. So you see, the first year might not be 12 months, it might be 12 months, it might be less than 12 months. But the second year is always 12 months from the day after the business started to the end of the next accounting year. So in our example here, the first year ended in 31st December. The second year must start from January 1 to 4 and end at the ending of the accounting year. We will call it 2015 year of assessment because it must be on preceding year basis. Now the third year and for every other year is going to be from January 1 to 15 to December 31st to 15. We'll call it 2016 year of assessment. So you see the difference. There is nothing like actual year basis. What does this thing do? Two things. One, it has cured the problem of overlap. So that means you are not being charged tax twice on overlapping basis period. That's one. Secondly, it has eliminated the right of election because right of election will normally be asking you to do actual year basis. It has eliminated your right of election. So there is no right of election anymore with this new finance bill, and it has helped us in our closing the gap of the overlapping basis period. Now let's go to capital allowance. In capital allowance, it is basically the same thing you did. Basically the same thing you did. No changes. But I told you that I'm going to do another method of calculating annual allowance, which I did here. That's why there is a difference. That's why there is a difference. Otherwise, there's not going to be a difference. I just wanted to use this to show you how you can calculate annual allowance. I'll just show you on some months. So let's look at the first month, the first year. Now, this is, okay, let me use this. Motor vehicle was bought for 2,400,000, right? And it was deemed to be bought on July 1. Initial allowance is 1,200,000. We know that already. Initial allowance has been calculated. So annual allowance is going to be divided by 4 years. When we divide by 4 years, we will prorate for the first 6 months, and we got 150. This was exactly what we did last time. Okay? When we less them, this is what we have as our tax written down value to be carried the next year. Now, how do we get this annual allowance, this 300? Previously, in that other one I told you, there is nothing like, this is not the capital allowance for 2020 finance bill. Capital allowance does not change in the Finance Act. The only thing that affects capital allowance in the Finance Act is that it will always be following the basis period. You know, normally, capital allowance basis period for initial allowance sometimes does not follow that of profit. It's because of this overlap and gap. But because the new Finance Act has closed the overlap, removed the overlap and closed the gap, capital allowance will always align with the basis period. So you have no issues with capital allowance. What I'm only telling you now is how to compute capital allowance another style. Now, when you calculated how you got this 150 was because you prorated. You said before, you said 2,400,000 minus 1,200,000. It gives you 1,200,000, and you divided by 4 years and you got 300. That 300 you got is what is your annual allowance always. So that's what you put here, 300. That is what you'll be putting always here, 300. You only prorate the first year. The second year, you leave it unprorated. Third year, you leave it unprorated. Only the first year you prorate. The same for others. So when you get to this one that has addition, it's the same thing. You bring this addition, you treat it separately, the initial allowance, the annual allowance. Of course, this one was used for the whole full year. You don't prorate. So you see, all the other ones, you don't prorate. But when it gets to the last year, you must leave your 10 naira. So it's the same capital allowance computation that we've been having that we are still having. The same thing now when it gets to tax computation, there is no difference. The only difference in commencement rule is that, one, the basis period has changed. Let me emphasize. Look at the comparison of tax between the old finance and the new finance. Your first year, you call it 2013. This is because the business started there. In the old rule, your profit was nil. In the new finance bill, it was not applicable because we normally charge preceding year basis. This 2014 was your second year in the old finance bill. In the new finance bill, it was your first year because you are doing preceding year basis. 2015 happened to be your third year in your old finance bill. But in your new finance bill, it is your second year. And mind you, there is no overlap in the calculation of profit. And so your tax, you are not suffering double taxation. But in the case of here, you suffered some double taxation between second and third year. And this is 2016. Supposed to be your fourth year, but the new finance bill is your third year. These two profits are supposed to be the same. But the difference here is because of the different way I calculated capital allowance. The difference here is because of the difference I use in calculating capital allowance. If I've calculated the two capital allowance the same way, they would have given me the same profits. So just know it's the same thing, but you can use any of the two methods. In fact, use this second method in calculating your capital allowance always. Once you have prorated, always prorate the first year, go back to that calculation before proration and use it all through. as your second year, third year figures, which is what I use in the new finance bill. And now, can you see the difference in the period? The difference happens to be 319,299. Give or take, let's say, what's the difference in these two tax? Because I know it's because of capital allowance. Let me find the difference. 186, 1,846, 146 minus 1,815,154. It's just about 30,000 naira difference. I mean 31,000 naira difference. So if you have to, this is 300 and something thousand, just say about 300,000 naira difference between the tax you are going to save by applying the new finance bill as against the old finance bill. You're just going to be saving yourself tax. Somebody is saying, please explain on the second method of calculating annual allowance. You have a cost. It's so simple. You have a cost, 1,200,000. 1,200,000 in the first year. Your initial allowance is 600,000. That means you have 600,000 to play with for your annual allowance. You know, I'm doing office equipment. You now said office equipment is for 4 years, and you divided it by 4. You have 150,000 as your annual allowance. That is this 150,000 that I put in second year. That is the 150,000 I put in your third year. It is what I got when I divided my first year figure, when I got my cost minus initial allowance. The difference, I divided it by 4 years. What I got as my answer is my annual allowance, 150. I'm supposed to put 150 in the first year. I'm supposed to put 150 in the second year. I'm supposed to put 150 in the third year because I got annual allowance 150. But I said no, for the first year I can't put 150. But I can put 150 in the second year. I can put 150 in the third year. It's so simple. But I can't put 150 in the first year. I only have to prorate the first year. Simple. This is a simpler method than the first one, when you have to prorate the first year, you bring the tax written down value and divide it by the remaining number of life. In this second one, you've just done it the first time and you've gotten a figure which you write somewhere. That figure is what you'll be using as your annual allowance. Only the first year you are going to prorate. That's all. That's not an issue. So note in this new finance bill, always on preceding year basis. Always on preceding year basis. That's point number 1. Point number 2, it is the accounting year end that determines when your year of assessment will begin. So if your accounting year end is December 2013, that means your year of assessment is 214. If your accounting year end is September 30th, 2013, your year of assessment is 214. Now, that is your accounting for the new finance bill. Now, this is what will suffice today. In our next class, which is going to be with me, your next class with me is going to be on the Saturday. Today is a Tuesday. On Thursday, we have another lecturer. But in my next class, which is Saturday, we are going to be looking at the new finance bill as it applies to cessation rule. The new finance bill as it applies to cessation rule. That will be the final for our lectures. So thank you so much. If you have any question, Please feel free to chat me on the WhatsApp chat because the time is clearly fast spent. We want to end the class now. Thank you all for coming. Ask your questions. Keep practicing. Keep practicing. In fact, at the end of today's class, I'm going to send you this FIRS circular about clarification on commencement and cessation rules and business reorganization. So if you see, that is where we got our law from the first year, second year, and third year. So I'll send it to you to read and make a revision so that when we come to the next class, we will discuss the cessation rule. We'll review this commencement rule, then we get to the cessation rule. Thank you so much for this class and see you again in the next class.